Today, we're going to take a look at Viridian Capital Advisors chart of the week titled SPACs Are Back. So if you remember that SPACs are a specialty purpose acquisition company, also known as a specialty purpose vehicle, SPV, sometimes known as a blank check company. But regardless of what you call it, essentially that they are a non-commercial operation set up by a group of investors that exist for the sole purpose of raising money through an IPO or initial public offering. SPACs were important to the cannabis industry because we don't have banking, and with cannabis set to take off, we're entering the second phase of market expansion. So the world is becoming more competitive, and some well-run companies that are actually profitable and have key markets are prime targets for bigger growing companies. At the same time, we've got a world of SPACs that are going to continue to drive valuations irrespective of buying assets. The growing infrastructure will continue to be required, more than likely coming from SPACs. SPAC capital, they're back, all coming up next. Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Again, we're going to take a look at a Viridian Capital Advisors chart of the week. What we can also see is average transaction size skyrocketing to near record levels at around $60 per transaction. That actually happened in the second quarter of 2019, closer to the third quarter, and then the pandemic kind of squashed that. Well, now it's back. And then we can also see the total number of capital raises actually trending downwards since 2018. So not as many transactions. Maybe people are looking more closely, doing more due diligence instead of just kind of gobbling up everything that they can see. Pretty wise. And before it was all stock, right? So then again, a lot of those M&As we saw and acquisitions were all stock deals, and those have all crumbled. So naturally, when you have a new economy and all of these companies trying to merge together, you're going to have artificially inflated numbers, and you kind of skew those out, and we'll see some normal numbers in another couple of years. We're seeing some large numbers coming out with SPACs, creating some interesting IPOs. During the previous peak of 1.1 billion of capital raises, it was driven by two large SPAC IPOs, Subversive at 575 million and Bespoke at 350 million. And similarly, this quarter, there's an upswing fueled by three large SPAC IPOs, Tuatara, 175 million, Silver Spike, 250 million, and Choice at 150 million. So out of the roughly $4 billion worth of cannabis SPACs that Viridian have tracked, only 2.7 billion have been de-spaced transactions to date. So that de-spacing is the time between or the difference between when an IPO was announced and when the actual merger of the entity happens. So there's a lot of milestones or requirements that are met, and if they haven't, then it kind of unwinds. I'm not an expert in SPACs by no means, but that's my rough understanding. So a lot of SPACs, they struggle to find enough targets to meet qualifying transaction thresholds. And then they were forced to put a number of transactions together and attempt some tricky simultaneous transaction closes. All in all, it didn't work out. And so some of these are unwinding or releasing their obligation. Essentially, once a SPAC is IPO'd, it has a timeline of 12 to 24 months to find a business combination until when the funds sit in a trust account. While they're sitting in that de-SPAC space, they might need a private investment in public equity or PIPE to kind of help push it through that de-SPAC transaction and help complete that process. So Viridian is expecting to see a smaller number of cannabis SPAC IPOs and more of them gravitating towards neo listings, which enable a broader selection of target investments. Neo is just an exchange up in Canada for some senior equity and finance. Kind of reminds me of like maybe NASDAQ or something similar to that. So to wrap this up, basically Viridian Capital Advisors is saying that from what they're seeing in the first quarter, it's kind of ran counter to the requirements of waiting 18 to 24 months when in fact there's an increase in confidence as part of those sponsors are actually able to list a lot earlier than that, assuming that they've met all their requirements, which they have. So to me, this looks like first mover advantages and opportunities, kind of get these companies fully vetted, fully into their portfolios, so that they can kind of continue to then either trade or use it as leverage within their portfolio mix. So if it's moving faster, that is a good sign of confidence. Hopefully we'll get some traditional banking, and SPACs will just kind of be that weird thing in the corner that they used to be when we called them SPVs, specialty purpose vehicles, that again, the blank check companies would find value in something and buy it, rather than just kind of used as a tool because of the lack of banking right now. So hopefully that'll change. Just kind of have to wait and find out. With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.